Interest rate on policy loans. There's one company I think that's at about 4.8 right now. There's another one that's at 6.85. There's one that's at 5.45. So they're a little all over the map. It just depends on where you're at. Just because a company has a lower loan rate doesn't mean that that's the right place to go put a policy, because there are many other factors that need to be considered, and that is something that is part of one-on-one discussion. Okay, so policy loans, how are they calculated? Okay, this is something that I think is helpful to know. I get questions on this from time to time. It's maybe not as big of an FAQ, but I certainly think it's important to cover. So these loans are kind of like a credit line, very much like if you've had a home equity line of credit or something like it's in that fashion. However, those types of things require a minimum interest payment usually. The insurance company doesn't. They just roll it up. And so the interest is based on an annual rate. Technically, you don't have to make payments, but it's very much recommended. If you don't make payments, then the interest will continue to grow. But a way to look at this is just very, very, very simple. If you had $10,000 and the interest rate was, say, 7%, and you didn't send a single payment back, the total interest cost would be $700 for the year. If you sent no interest payments back, then starting in the next year, you have $10,700 owed. That's how it would work. Very, very basic. And the key thing, though, is that your cash, as we talked about, continues to grow even though there's an outstanding loan.